Hi everyone, this is Jason Barrett of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. Had him on a number of times. He's my good friend and also one of my mentors. Taught me a lot about commodities, and we co-authored the Dragon Metals report in, I think, 2011 about the rare earths market. Kevin Kerr of Kerr Commodities Watch, thank you for coming back on.
Thanks, Jason. Good to be here today.
Now, Kevin, you've been through a lot of commodities markets. You traded on the New York Commodities Exchange, and including with Paul Tudor Jones since 1989. So you've been through a lot of bull markets, a lot of bear markets. What's your opinion of what's going on right now in the oil market in this enormous correction?
Making me feel old, Jason. What is going on now is we're seeing a lot of pressure. The bulls have really been beaten down here. I don't think there's really any commodity except maybe the grains here recently that have been in bullish mode. Everything is just getting crushed. The metals have been crushed. Oil certainly has been crushed. I'm sure we'll talk about that more extensively. But, there's really not any of these markets that have had an uptrend for a long time here. And with the stronger dollar, that's hurt these markets as well. So the bears have been having a field day. Now we're getting to some levels where we really have to think through if there is a lot more potential downside to some of these markets, or if it's time to get back in and get long again.
Yeah, the Wall Street, conventional wisdom on Wall Street now, and you hear this from most of the talking heads on CNBC and Bloomberg, the people who have worked on Wall Street their whole careers, most of them don't really travel the world. They don't go see Main Street. And what they're saying is the commodities bull market is completely over. It's dead. There'll never be a commodities bull market again. That seems to be the mainstream thinking here. Precious metals are dead. The oil price are dead. China is a total disaster and will not grow anymore. But when I look at the people in China, the data, we still see car sales increasing in China. So there are bullish points, and I'm not grasping at straws for why the oil market, it's not sustainable for these oil prices to go to $60 a barrel or $50 a barrel or $40 a barrel. Because, at the beginning of the year in 2014, there was a whole bunch of studies that there was still strong demand growth coming out of the developing world.
Yeah, let me back up a little bit. What you're saying is exactly right. And of course, we've heard this before. If you remember the last time oil dropped down to these levels, after we got up to like 110, 112, and it crashed down to like $20 or whatever it was. And I remember analysts coming out, I won't name any names, but saying, oh, we're going to be a sustained oil price of $10. It's going to stay there forever. Of course, it did not. Basically, didn't stay there very long at all, and went right back up to 90, close to 100, a little above 100. And, then we went back down to 90, and now we're suddenly crashing again because, of course, OPEC isn't cutting production. And that's enough. With as much oil as we have in the market, as much as the production has increased here in the States, we are seeing a glut of oil and fear. And so those prices have crashed. And I think they will probably have potential to crash quite a bit more. And, as you pointed out, the cure for high prices is high prices. The cure for low prices is low prices. That's what we say in trading. And it's true. We're at that choke point now for a lot of these shale companies and the offshore drilling that goes on, all that expensive stuff. And I don't care what reports are coming out, and there's plenty of them saying, hey, we're sustainable at $30. We're fine at 45, I think the number for most of these companies truly is more like 65, 70, and we're right there. It's probably really around 90 for them to really be firing on all pistons. But just to break even or profit, I think it's more around 65, 70. A lot of people say I'm wrong. The companies themselves are saying we're fine. I, in fact, think many of them, most of them, are leveraged. They've borrowed a ton of money. They've hired a ton of people. They have huge expenses. And they can't ride this out as long as OPEC can. It's certainly not as long as the Saudis can. So we have all that dynamic building up right now in the energy markets. And what people don't understand is even though it's great, and I was on Fox News last night talking to Neil Cavuto about this. The bottom line is, yeah, everybody feels great. It's holiday time. Everybody needs a little bit more money. They go to the gas pumps in Oklahoma and they're paying $1.99 for gas a gallon. And we're paying about $3.50 here in Chicago. And the reason is mainly gas taxes, but we're actually seeing gas under $2 a gallon. It's who could complain about that, right? But what people are not figuring out is that longer term, if we want to maintain this energy independence, which we have to some extent, we're not even importing oil from places like Nigeria anymore because of the production at home. that's all going to come to a grinding halt. The production will shut in. A lot of these really weak hand projects will fall apart. They have hedges, some of them out to maybe Q2 of next year, but I don't know of any company that's hedged further out than that on the curve. So when those start falling apart, if this price is still low, I think you even see some of the bigger ones go, certainly shutting down wells that aren't profitable and cutting a lot of these jobs that have been created across the board. And when people think about jobs, they think, oh, it's just a guy out working at the well. It's not. It's the transport. It's the train builders that build all the cars for that. It's the towns that have sprung up all over North Dakota and elsewhere in Canada. It's a lot of things and a lot of jobs. So the picture with lower energy prices is really, truly a double-edged sword that, if you really believe it's a sustainable price at these levels, you're nuts, because OPEC can't keep it at these prices either that long. They don't want to, and the whole reasoning, in my opinion, that they've done this is to hurt America's domestic production longer term. And while it helps us a little bit with Vladimir Putin, albeit I don't know how much, it's bad for the U.S. long term. It's going to destroy our progress forward that we've made so far in oil independence. And a lot of people, I think, are under the illusion that once those prices do start to go back up, or OPEC cuts production, that we'll just flip a switch and all of a sudden we'll turn all that back on. And it just doesn't work that way. A lot of investors are going to get burnt on this. They're not going to have the stomach to come back in. A lot of these companies will be shut down and not be able to restart right away. It takes time to do all that. So we're going to lose precious time. It's going to end up costing more. And these times of low prices, people are going to look back on it and go, what did we do? We made a mistake. This isn't good. So that's kind of where we're at in the energy patch right now, in my opinion.
Yeah, people should enjoy these cheap energy prices while they last. Like, I know people are thinking, a lot of the conventional analysts are thinking that it could be this way for a long time, but I just don't think so. Obviously, you cited 2009. I think that was a good example. China was astutely, when the oil price crashed from, I think, 140 or so down to like 35-ish, China was in there doing long-term oil contracts with both Brazil and Russia way above the spot price, $15, $20 above the spot price at $50, $55 a barrel. I remember the talking heads on CNBC and Bloomberg, oh, China's stupid. Who the heck would pay, $20 above the spot price for 10 or 20 years worth of supply? Well, a year later, the oil price was way above the price China locked in. So China's I'm sure China's in there buying the oil, locking up the contracts now, getting the supply long-term at way above the spot price now, and I'm sure the lower the oil price goes, they're going to continue to do this. And that's probably what a smart long-term investor should be thinking about here is, is this low oil price, is it sustainable? And you cited a whole bunch of different stats there about why the shale oil companies can't really make any money at these levels. If they were making money at these levels, why did they need so much debt then? I know debt's cheap to borrow for them, and it's subsidized thanks to the Federal Reserve and fractional reserve lending and all this other stuff. But if you have such a good deposit, why do you need the debt? You should have the free cash flow, right? You should be able to fund all of your operations just from operating cash flow. And we really haven't seen that for a lot of the shale oil producers. Some of them do, but a lot of them don't. So I think, like, it's just all talk. It's like, with the gold and silver mining companies, right? How a lot of them are saying, oh, our cash costs are $10 an ounce for silver or $800 an ounce for gold, right? And now that the gold and silver prices have dropped down so much, obviously, they were drastically understating their costs because the cash costs didn't include like at least 7 different other major expenses I can think of off the top of my head that they weren't putting there in their all-in costs.
Well, Jason, you've hit the nail on the head. You're astute as usual, as always, I should say. Absolutely. A lot of these companies, these shale companies, are paid on how much debt they have. I mean, not how much production they're doing, but how much debt. The more they can borrow. It's kind of bizarre, but you're right. I mean, it is cheap, easy money right now for them, or it has been anyway. It's been kind of a heyday, and of course, production has been fine with oil at around 95. But now here we test the waters at 65, and suddenly there's a crisis. And I hear a lot of people that disagree with me coming back, or the company saying, we're break even at 45, or we're break even at 55, or even 65. If you look, there's a great chart online that's going around that shows every major oil project, shale or otherwise, that's going on in the world, and it shows where their break even level is. And most fall above 65. There are many that fall below, but that's right around break even for a lot of these. Now, none of these companies are in this business to break even. They're in this to make money. And quite a bit above the break-even price. So it's really kind of ignorant to say, well, they're at break-even, they'll be okay, because they're not going to stick around in this business to break even. They're certainly not going to keep all the people they have or keep all the projects going that they have. So it ends up self-imploding. You know, they start cutting projects. Now they got no production, they can't pay their bills, and they're out of business. So it's a very big domino effect here.
Exactly. Well, you can work for a little while break even, right, if you're not using too much debt. But if you're using a lot of debt, you can't run at break even because you owe huge interest payments. Right. I mean, maybe you can talk with the banks and your lenders, right, and you can get some payments postponed or something like that. Maybe they'll work with you, maybe. But you know, then they're going to want extra seats on the board of directors. They're probably going to fire most of the management team. They did that with Chesapeake Energy and Aubrey McClendon. You know, he was just leveraging to the hilt there when the natural gas price was rising, and then he ended up, you know, getting kicked out of the company he founded and built from basically nothing because he took on too much debt and he got greedy with taking on too much debt. So I think that's going to happen with a lot of these shale plays is that people who I read the book The Frackers. It was just an amazing innovation story of these guys who pulled oil, you know, basically out of these very difficult rocks. And, you know, they did stuff that most of the rest of the world has not been able to do in terms of producing economic oil from shale. And it's an amazing technological feat, but it's not cheap oil anymore. So, yeah, I think you're right. Maybe in the short term, we do go quite a bit lower, either putting pressure on Putin or what the Saudis are doing. Maybe they're playing both sides. Maybe the Saudis are helping the U.S. hurt Putin, or the Saudis want to bankrupt the shale. Who really knows what the exact truth is, unless you're, you know, working in OPEC or you're in the Saudi government. But it's just really interesting to see that the oil industry is the largest industry in the world, I think, right, Kevin?
It is, truly. Yeah. I mean, because, of course, it touches every other industry. So it is definitely one of the biggest, if not the biggest.
Now, I want to get your opinion here since you've lived in Estonia and in Eastern Europe. What's your opinion on capitalism in Eastern Europe? Are we seeing a good amount of capitalism there? And also about oil prices and Putin. Do you think then that the U.S. is trying to do this to, you know, with the invasion of Ukraine and knocking down the ruble and the oil price? Do you think this is going after Putin then?
Wow, great question. You know, yes, and let's just establish where Estonia is for any of your listeners who don't know where it is. I mean, I live there because of my wife and my kids, and my kids are American and Estonian, and my wife is Estonian, and it's an awesome place to live. Freedom index-wise, it's one of the best countries in the world to live in. Only about 1.5 million people, nestled right in the Baltics, part of the EU. We use the euro. We're part of NATO, but we are right on the border of Russia. So we're right in the thick of it. And of course, Estonia, Latvia, and Lithuania, like so many other countries, used to be part of the Soviet Union, and Estonia gathered its independence again in 91. So we've been independent since 1991. Through self-imposed austerity, the country basically took on the euro and is doing very well. It's had one of the best GDP to debt ratios in the world. Very high quality of life. So that's Estonia. And what is going on there as far as capitalism? It's just growth, Jason. You know, the entrepreneurship that I know America for, that has helped me build my business and, you know, has kind of disappeared. It's almost impossible for new entrepreneurs to get funding, to get through the regulatory jungle, to make a living, to build a product, or to innovate. A country like Estonia has lifted a lot of those barriers. In fact, it's the first nation to have what they call e-citizenship, which is really, really unique. It's basically being a citizenship without borders, to bring in new skilled people and people that want to contribute to the country, but not even have to live there. It's kind of controversial, but it's very advanced technologically. IT industry there is huge, and the government's very supportive of free markets and capitalism, true capitalism, and creativity. So it's very sad to say, as I'm American, but I feel much more open to building my business there than I do back here in the United States. So I would say it's alive and well. Now, of course, the things that have occurred with Putin and moving into Ukraine have shaken the area. President Obama is only the second president, I think, to ever visit Estonia. Just came to our country a few months ago and assured everybody there that, you know, an attack on Tallinn, which is the capital of Estonia, is just like an attack on, you know, London, and that NATO would defend it just as much. Do I believe that? I do not. And I've said it on the record, on television. I would say it again here right now on Wall Street for Main Street, that I do not believe that NATO would fully respond to protect the Baltics, Estonia, or much of Western Europe, quite frankly. I think that the United States will not on its own. It can't. We're bankrupt, and we have too many other wars and stuff going on. So, the reality is that there's that danger hanging over. Now, of course, it is technically an act of war. If Putin were to invade, say, the northern part of Estonia, to help the Russian-speaking population there, like he did in Crimea, but it's a real possibility. So, there is that specter hanging over the whole area. But at the end of the day, you wouldn't see, I don't think if you went up to that region in Estonia, any of the Russian speakers there, not like Ukraine. Ukraine is a lot poorer, that they would say, yeah, I definitely want to be communist again and move back to Russia, because they enjoy a much better life in Estonia. They're probably earning 2,000 euros a month rather than, 200 euros a month they would earn in Russia. They have better quality lifestyle. So the last thing they would want to do is probably go back to Russia. But, it's very tense times, and certainly those risks exist. But oil-wise, energy-wise, any of the Baltics, Estonia, Latvia, Lithuania, and by the way, just a side note, Estonia has huge shale deposits in shale oil. And a lot of experts from there have come over to help with the shale mining here in the U.S., including a couple of big companies. So Estonia is highly dependent, if not completely dependent on Russia for energy. So is Latvia and Lithuania, and actually the whole region. So, and Germany is 40% dependent on them for fuel oil. So, this whole thing could get very messy as the winter goes on, and Putin has his little temper tantrums, and the ruble keeps getting crushed. And we'll just have to monitor the situation and see what happens. It's really day to day.
Yeah, it seems what Putin has done is he's promised a lot of that natural gas that used to go to Germany or the Baltics or the rest of Western Europe, and he's started giving it to China.
Right.
There's just been enormous, natural gas deals. I think $1 trillion natural gas deal with China was announced in the last couple months, and there was a humongous one before that too. So it's just really interesting, all the things that are going on behind the scenes. It doesn't seem to be, the market doesn't seem to fully understand this right now, the ramifications of this to the petrodollar or to commodity prices going forward. But it's definitely really interesting in terms of the bilateral trade agreements and the things like that that are going on, and then the geopolitics that are involved. It seems there's a chess match going on between the U.S. government and Putin, and Putin seems to be to winning the chess match right now at this point in terms of the mainstream financial markets. The ruble has gone down a lot, and it is hurting Russia in the short term. But Russia, with all their oil profits, I think almost 100% of their trade surplus money each month now goes into physical gold, and they're doing all these deals with China and other people to get out of the dollar. And you don't hear any of this mentioned. Nope. On CNBC or Bloomberg, that we're getting out of the dollar, we're doing all these trade agreements. You won't hear it mentioned once. Yeah, you and me got to find this info out online. But it's every other news station pretty much outside of the U.S. and Western Europe is talking about it like crazy, these trade deals.
Well, and let's face it. I mean, you're seeing, the Swiss just voted it down about repatriating their gold, but the Dutch want their gold back. Like, give us our gold now, And then we've got a French presidential candidate. She says if she gets elected, she's going to demand that France's gold get returned from wherever it is. And, I think the Swiss will rethink this. They'll be at the back of the line. But a lot of these countries are saying we're repatriating our gold. We want it back. And I will tell you this, I'm sure, and it's not reported on any of those mainstream networks, you're absolutely right, that China is very quietly but yet pretty openly buying gold. Russia, as well, as you pointed out, openly doing it because they're ready to develop their own petrocurrency. Ruble, yuan-backed, gold-backed petrocurrency. And the dollar's time as the reserve currency or the petrodollar, those times are truly coming to an end. And I'll get back to one other point I made. For example, with Nigeria. So when all this goes on and a lot of these shale oil, where this oil is coming from now domestically, go under, and that production gets shut in, we're going to have to turn back to the places we imported oil from, places like Nigeria, where we constantly have problems. Anyway, Venezuela, and, of course, the Middle East. All very big choke points. The problem is that right now we're not importing anything from Nigeria. So they have to desperately seek out a new buyer. Well, who are they going to go to? Exactly what you said, Jason. They're going to go to China, and they're going to say, oh, you'll buy our stuff for $20 over spot? We love you. We'll be with you forever, right? And now we will no longer have that grocery store to stop at. It's going to be gone because that Nigerian oil will now go to China or wherever, But we're not their customer right now. And they're going to remember that. They're going to strike a deal with who's going to pay the most. So
yeah, China's doing. If I could add to your point there, China just did a big trade deal, I think, with Canada, where there was a big bilateral trade agreement and currency swap line set up with Canada. I think $30 billion for 3-year deal, and they're installing RMB yuan trade zones for the currency, I think, in Canada. So they're setting up, the ability to open up their currency, the Chinese currency in Canada, because they know they're going to be doing those long-term contracts with Canada. The resource prices have dropped so much, the Canadian dollar has fallen like a rock. Canada still has very attractive assets long-term, although, right now the commodities, we've been in a cyclical bear market for the last couple of years, but the Chinese don't think short-term. They're not
exactly.
Yes. So the Chinese are saying, you know what? We see a big sale. It's like at an after Christmas sale or like a sale at the grocery store, right? Where yes, we don't need something we really want. We don't need it right now, but it's on sale and we could lock it in at a great price. So I think that's what the Chinese are doing right now with Canada and Australia and some of these other countries that have had, their commodity prices drastically drop. I think they're starting to do some bargain shopping.
It's a great point. It's a perfect point, actually, Jason. It's like when you walk into like CVS or Walgreens the day after Halloween, and they already got the Christmas stuff coming out, and everything in the Halloween stuff is all like 50 cents, and the day before was like $5 for a bag of candy. It's the same thing. It's exactly the same thing. So you're right too. I mean, we have to realize our country's been around a little, over 200 years, but China's been around for thousands of years. They've been trading for thousands of years. This is in their nature to think long term. And they are looking at the long curve of this, and we do not think long term. We don't even have an energy policy in this country, really. So we don't have any real long-term plan. And of course, this hot air that the reserve currency, the U.S. dollar, is floating on is just nonsense. I mean, there's nothing really to back it up. We haven't cleaned up the mess of all the printing. There's probably going to be more QE, but it just won't be called that. Because you've got to maintain the circus. In the meantime, Russia's letting their currency free float. Well, why are they doing that? Why would Putin expose his currency to float freely on the market? Well, of course, if they're going to develop their own currency and they want it to eventually. Sure, it hurts right now, just like you said, but long term, that's the way to go, And so their partnership with China concerns me a lot. Our removal from China, basically. In other words, our relationship with them is crumbling as they grow closer to Russia as well. And, of course, them gobbling up resources from places we're going to need it from again because, we just are. And so we're really setting ourselves up for some serious problems longer term in this country. We're not going to have access to the sources we did before. We don't have the relationships we had before. And the money printing press and, hey, let's sell you some more of our bonds program is over. Nobody's buying the junk we have to sell anymore. So it's really quite a frightening time because I do see people enjoying the low prices for the moment. This is like a blip on the radar screen. Even if this is a several-year bear market, which I don't see, it's just not going to happen.
Yeah, Kevin, because it seems that, I don't know, we were talking about this before we started recording. It just seems that almost nothing is working on the long side for the commodities markets right now. Now maybe there's a few commodity companies here or there that have cut costs or they found a humongous amount of cheap oil or something like that, or there's a mining deposit that's gone into production or something. There's a few small examples here or there, but across the board, when you look at, the gold mining market, the silver mining market, the oil producers, the oil producers were the shale oil producers were the darlings of Wall Street the last couple of years up until the last 5 or 6 months. They were in a humongous bull market for I think since like 2009ish. They were in a humongous. They were up some of them many hundreds of percent, and Wall Street was just they were buying the equity like crazy. They were buying the bonds like crazy. But almost everything else other than that, and even those are down a lot now. Some shale producers. The market is indiscriminately sold off. Some of them are down more than 70% in just the last couple months since the summer. But almost all the commodity producers, none of them have seemed to be doing that well right now.
No, it's all red across the screen. I mean, it really has been, and especially in the major markets like energy and metals across the board in those, and really no fundamentals are going to change that. As far as certainly like weather in the energy market, even if we had an ice cold winter, the amount of energy that's on hand right now and available is going to keep these prices low for quite a while. But I think the speculators, often the speculators get blamed when markets are rallying and prices are higher. But of course, speculators help push these prices as low as they are as well. And so we don't hear about that a lot. I mean, speculators serve their purpose in the market, but they go both ways on it, up and down. So we've had a lot of vol in this, and a lot of this stuff I think now is sold off to the point where it really is an attractive buy. But the thing is, you have to look at it on a case-by-case basis in the commodities. There's still a lot of pressure, a lot of unknowns, and the government's still pumping out a lot of this data that the market seems to suck up like candy. And, the employment numbers recently, just kind of confusing to say the least. And when you really dive into the numbers and you see what they're based on, a lot of part-time work, a lot of low-wage type jobs, it's concerning, So a lot of this data moves the market, but it probably shouldn't. And so what's going to rally first and when, it's really pretty much anybody's guess. But I do not anticipate oil prices staying down here that long. I also think OPEC can't, or the Saudis, I should say, because they're really behind this, can't not cut production. They have to cut production pretty soon because the smaller countries in OPEC are going to really suffer. The Saudis can handle this for a while. They can handle prices at 65 or lower, but a lot of the smaller countries in the UAE cannot. And so, how long they can hold out versus the shale companies, who last longer, that's anybody's guess. But that's where I see the tipping point for oil. And then I think the snapback on this, I look at it as like rubber band. You stretch the rubber band as far as you can, and it just goes snap, and it flies back. And that could be what happens in the energy sector. And again, then, we're going to put our hand out and say, where can we get more oil now? Let's go back to our friends in Nigeria. Nope, go away. We already have deals with China, or we don't have any relationship with Russia. And the Middle East, could be scattered, It's just really hard. And the dollar won't have the buying power it had because it'll no longer be the reserve currency. I do see that scenario down the road, or certainly not the only one that's out there, and not the petrodollar anymore. People are going to want to trade in their own currency or in this new gold back, something with a solid backing. Let's put it that way. No more promises from the U.S. government.
Now, Kevin, you mentioned trading volatility there. One of the things about the commodities markets, I think speculation is good, short or long, but I think we just have too much speculation with these high-frequency trading programs, and there's just too much paper out there. So there's a lot of paper oil, there's a lot of paper gold, there's a lot of paper silver. There's more than 100 paper gold contracts, and if you believe the numbers, I think more than 400 paper silver contracts for every real ounce of silver backing it, and 100 paper gold contracts for every real ounce of gold backing it. Do we really need that much paper for speculators to move the markets up or down? When a smaller amount of speculators to allow the producers of gold or silver to hedge their prices or make a profit or things like that, do we really need that much paper in the commodities markets to allow for traders for volatility and stuff?
Absolutely not. No. And okay, two things. The high-frequency trading has changed the entire game of trading. And this is why I really believe we're seeing as much volatility as we do. Where we can see the oil market move $10 on either side of unchanged in a day. That's insane. When I started in this business, if it moved 50 cents, and I don't want to date myself, but if it moved $1, that was an incredibly volatile day. So the HFT has really added to the volatility.
I think HFT is just really efficient at manipulating markets.
Yeah, it is. And again, I'm not one to squelch free market capitalism, but then there's a time when you're destroying markets or you're really interfering with the natural process of the market that you have to question what is actually happening here. Because, you can kind of throw all the fundamentals and even the technicals out the window when that's what's going on.
They're pulling these HFT machines as a trader. You're not supposed to, once you make an official bid or offer, right? You're not supposed to be allowed to pull it, right? But these HFT things, they're pulling bids and offers. Right. They're trading against each other. They're front running, which I was a stockbroker. If you front run any of your clients, it was a felony. You go to prison for that. But they legally do that with the front running of the orders that come in. And the exchanges know this is going on. They look the other way because exchanges are getting kickbacks and commissions for high trading volume, it's ridiculous, Kevin. It's an efficient way of manipulating markets with these high-frequency trading algos. They see the orders on the book if they're a market maker. They blow out your stops. So when gold was at, I think, 1180 or something, right? Or it was 1250 or 1180. I forget the key support level. And everyone and their brother had a stop there, right? Because it was a key support in the chart. Everyone could see it. I mean, these high-frequency trading algos saw that, and they intentionally, they saw the whole order book, and they just blew out all the stops and took the market down below there intentionally.
Yeah, I mean, Jason, I've commodities traded for a number of years on the floor, and of course, I was brought up with the understanding of what you can and can't do, and so now all those rules seem to be out the window. Especially when you were talking about the HFT, and like you said, they're doing stuff that's just, you look at it in my school anyway, you're breaking the law, and yet it's totally legal. And you're right, the exchanges back it and don't interfere with it because they're making a ton of dough off of it. And it's really hurting the free market is what it's doing. Front-running customer orders in the old days, doing that destroyed the integrity of the market. It's no different now. So that's going on, the smaller trader, the average trader, even the bigger trader that's out there that's not part of this, is really being hurt by this kind of activity. And yet it's acceptable today, yet it wasn't 2 decades ago, or a decade ago, or even it's still, as far as I understand, it's still illegal for some people and not others. So it's scary. And then, with the HFT stuff, that certainly affected it. As far as all the paper sloshing around out there, I'll tell you what's going to bring that to fruition. These countries that want their gold back from Canada, from the United States, if the United States even has it, that's what I'm waiting to see. I'm waiting for the first country to come and say, we want our gold from the New York Fed or wherever it's stored, and we want it right now. And let's see if that's really gold, or let's see if it's, tungsten, spray painted gold, or let's see where that gold is. I would like to see my gold. And so if they can't produce it, that's going to be disaster number one. But if they can produce it and it's repatriated, so now where is that physical gold that's backing all this paper? That, the paper that says it's backed by gold. Because we know all this paper can't possibly be backed by gold. As you pointed out, there's 400 times the amount of, paper out there or whatever it is. I mean,
well, for silver it's 400, and for gold,
right.
I think it's about
for silver. So let's call that. Let's say, where are you going to find the silver to physically deliver me the silver on these paper contracts that I bought when it's only about 20% of the number that are out there? Let's say it's a run on the bank. Everybody wants their silver right now. And that's the scary thing. Is that going to happen? I don't know. The point is they couldn't meet the answer if they had to do it. And that's where the rubber hits the road. And this stuff is not backed by anything. So it's worthless in my mind. So no, do we need all that stuff out there? No, we need to clean it up. We need to cut back on it, and we need to curb in a lot of this type of trading and set the rules so that it's a level playing ground for the average investor, as well as the big players who have this technology and ability to seems to circumvent the law.
Yeah, I agree with that, and I hope long term that those are problems that gets fixed. But in the short term, it seems like the CFTC, the Commodities Futures Trading Commission, the big banks have, they send Goldman Sachs people there to run the CFTC, and they spend a lot of lobbying dollars to make sure that these guys don't change the rules that hurt the banks.
Yeah, and let's face it. I just want to say one thing about the regulators. I mean, there are two of them that have failed miserably, repeatedly. The SEC and the SEC. I mean, the SEC and CFTC. Look, the CFTC missed out on MF Global, PFG, several other major firms that blew up with just vast corruption, and a REFCO, and then of course the SEC with things like Madoff, and the bigger players that have blown out and really, really screwed people. And they just, under their watch, these people just skated along. And I've dealt with both these regulators and never really had a problem, but I know many people, smaller businesses, smaller brokerage, and smaller advisories that have had major problems with them. Yet these bigger fish seem to just slide by. These regulators have not really helped the markets either in any way at all, as far as I'm concerned.
Yeah, I agree. Especially when there's people out there who have a good business idea and want to help customers and help make them money and lower the fees for the customers who can offer a more efficient business operation, but there's higher, barriers of entry because regulatory fees and compliance fees, and only the big guys, when your compliance fees are six figures a year, only the big fish can really afford those compliance fees. If you're a good entrepreneur with a good business idea and you want to get into those industries, you can't get in those industries because the barrier of entry for regulatory fees and compliance fees is so high.
Like I said, it's what I was saying earlier about entrepreneurship and working in Estonia, building a business. It's the same thing here on this side, regulatory-wise, as far as this goes. The amount of regulation that's in place, like you said, your compliance budget is through the roof. And all those costs get passed on to the customer. They have to, or the business couldn't stay going, or it never gets started, like you said, because you don't have the capital to bring in the compliance you need to meet all the government regulations for these agencies that at the end of the day don't really protect any of us as far as I'm concerned.
Yeah, I mean, the best protection people can have, Kevin, is educating themselves, learning skills, asking better questions to their financial advisor. If they have the time and effort and want to do so, learning to manage their own money, either investing or trading in different asset classes and things like that. But most people don't have the time or interest to want to do that. And that's why the financial industry gets so rich, predatory and making so much money off selling high commission garbage and fees. So
right, and a lot of times it can be somebody that seems like they've got a lot to offer. Look at the story of Bernie Madoff and his Ponzi scheme is a classic. It went on for almost 3 decades or something like that. And he would go to these people and they'd say, well, I'll give you 10 million. He'd say, well, that's not enough. I need 20. And everybody on Wall Street, or many people that I've spoken to, knew about it. He knew what was going on, or had an idea what was going on, and yet it didn't come out. Why did they know what was going on? Because they were putting out these false statements with stocks that didn't even exist anymore. And the customer didn't care because they were getting money. It all seemed to be humming along fine, and the regulators would go to Bernie's office, and he wouldn't meet with them. He'd have some, underlings meet with them. But nobody wanted to make Bernie mad because eventually these lawyers that from the SEC want to go work for him. They're going to make $4 million a year working for him, and they're making 80 grand with the SEC, so they wouldn't look through his books, If they came to my office, they looked through my books because they didn't really want to work for me. But when they went to Madoff's office, they didn't ruffle any feathers because you don't want to rock the boat. I mean, this is what we have in place right now to protect the American investors. Absolutely. And your listeners, they get so much great stuff from you. The best advice you just gave, everybody has to do their due diligence, find sources they can trust. I would say off the grid a little bit and really look at things closely. And that's the most anybody can do. But boy, it's just a wake up call when you start looking at some of this stuff.
Yeah, I completely agree about the SEC and working for the mainstream financial industry. I don't really want to work for the mainstream financial industry anymore. I've had my share of working at jobs as a stockbroker and investment analyst at larger firms. Now, Kevin, my final question and topic here, I want to talk about the precious metals. We've just had a really rough bear market the last 3 years. I could cite you cite you fundamental analysis talking about supply and demand data. China's buying basically almost 100% of the annual gold mining supply, according to Kuz Jensen of BullionStar.com. 100% of the annual gold mining supply all by themselves. They bought that much last year. When you add in the amount of physical gold that India's buying, when Russia's buying, it's more than 100%, way more than 100% of the annual mining supply. India increased their, I think, silver demand by 18% last year, which is, it was a very tight market to begin with. And yet the silver price fell dramatically. What's your opinion on the precious metals markets? Do you think the bear market is almost over?
Boy, this is probably the toughest question you've asked me and really a difficult one for me to answer because in my mind, I see a lot of the things that are in motion right now, and I say gold should really, this is probably a bottom, or we're close to it. There could be another major capitulation, but I just see this cavalcade of, supposed positive data, the Dow making new highs every day, the dollar somehow, eking out gains over the euro. And so I'm cautious because, this market really, the Dow anyway, wants to go higher and everybody wants it to be happy days are here again and gold's getting the bad rap. And it's pretty on technical lows right now. So it certainly has some space to move lower, but we have got to be close. And I'll tell you, the catalyst here could really be a lot of these countries that are coming forward now deciding that they want their gold back, starting with the Dutch. It could move into, Italy. You could just pick every country that you can think of that has gold holding somewhere else, wanting their gold back, and all of a sudden getting in line, kind of starting a little bit of a panic. and there you go. They want their money back. Basically, they want their gold back. And that could really be a game changer for gold. And I will tell you the biggest one, though, is when it really is clear that China is buying gold hand over fist, that they're going to have a gold-backed currency or a gold-backed petrocurrency based on the yuan, ruble, and gold or some other form of that, and basically state publicly they're getting away from using the dollar for these deals. And designing their own plan for the future. And America and its U.S. dollar are not part of it. That will be the death knell for the bear market in gold. And so, we could see dramatic increases then. How fast that happens and when it happens, I don't have a crystal ball on that one. But I think we're seeing a lot of the early signs of that right now. People, for the meantime, are going to continue to look at this like, kind of phony employment data, try to find the good all the time.
And how there's no inflation either. Yeah.
How there's no inflation.
Yeah. The mainstream stuff is that there's no inflation, unemployment's improving, the U.S. economy is recovering, GDP is still improving, blah, 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 blah. But, with these shale oil prices, you mentioned the jobs. I mean, the jobs multiplier is going to drop like crazy if these shale oil production things start cutting back pretty drastically.
Yeah, I think, in final thoughts here, I mean, that the signs, the writing's all on the wall. It's really what you believe. If you're really still drinking the Kool-Aid and you think that these numbers are real, that we don't have to clean up the mess we created, that there really isn't inflation. And it's hard to see it right now. I'll give you that. But you can feel it. You can feel it in a lot of different areas, maybe not in energy right at the moment. So there's a lot of denial going on. Eventually, and not probably very far off, it's going to become very apparent. And as the oil prices ramp back up, the pain will all come back. And I would just say to people to take a long, long look at the future, not have just the short myopic view, but take a long look at what their investment should do for the longer term and where they should be to position themselves and hedge themselves.
Yeah, I agree. Well said. Now, with the precious metals bull market, you talked about the demand side. I think the problems could come on the supply side. I think I look at miner balance sheets. I cover the gold and silver miners pretty extensively. I don't think the miners have – I don't think that many of them can survive another 12 months if these prices are lower. I think there's going to be an enormous amount of bankruptcies in the next 6 to 12 months if prices stay at these levels or go lower. And I think then that's going to eventually, especially in the silver market, because unlike gold, silver is used for so many industrial purposes, and a lot of it's not recycled. I think there's going to be potential supply shortages then on the silver side. Maybe, they go into SLV and they start stealing the silver, or if they haven't already done so, they start taking the silver out and they lie about how much silver is in SLV. I think they've already done that in GLD. But there's going to be supply shortages. I don't know if it's going to be 6 months. I don't know if it's going to be 12 months. But, the miners are just they're going to crap out. The debt's not available anymore for them. The equity is not available for them. They burn through, many of them, the cash in their balance sheet. A lot of them, especially the silver miners, they're running their silver mines at $4 or $5 an ounce loss.
Right.
For every ounce of silver, it's not sustainable.
Right. Nobody can sustain that. Exactly.
Yeah.
And look at throughout history, we've seen this. When central banks, or what they were back then, even in the Roman times, they cut out the quality and quantity of the silver in the coins, that's, to boost the reserves. So, that's what's going to happen again. They're going to dip into the gold and take what they need and, put back a little less in whatever. And like you said, shift it over, take some out of SLV and move it around and take Peter to, pay Paul and all that stuff. And so that's going to start next because, like you said, it's not sustainable at negative $5. It's not going to happen.
Yeah, I agree. I think that's going to be, if we start seeing an enormous amount of bankruptcies, I think that'll be the bottom. But we may have already bottomed it. We won't know until the hindsight. I mean, obviously, I thought we had bottomed before in the last year or two. Thought there were many instances of bottoming, but it just didn't work out. The powers that be, I think there's just so much shenanigans that goes on. As a trader, Kevin, when you want to sell a contract, you want the price to go high. You want to sell at the best price, right? Mm-hmm. You don't normally, if you're unless you're a not-for-profit seller, you normally don't want to blow out the market and blow out stops. If you want to sell your position that you've made on the long side, you want a higher price to sell, and we haven't really seen that in the gold or silver market.
No, and I think, like I said, I think there is, right now I'm cautious because this is all still going on, but it's starting to crumble. The facade is coming off a little bit. but the house is still standing, you know. So the time is coming, but I just think right now, as you look at the Dow, the hysteria is still kind of going on, and low oil prices haven't helped much either, but it'll all implode. When and how soon, I don't know. Like you said, it was 6 months. Is it 3 months? Is it 12 months? I don't know. But we have to really monitor what comes out, what's happening, and it could be very sudden. So investors should really pay attention.
Yeah, I agree. Now, I want to thank you again for your time, Kevin. Please tell our listeners more about your newsletters.
Yeah, absolutely. Our flagship basic commodities newsletter is called Kerr Commodities Watch. We're at Kerr, Kerr, commoditieswatch.com. And we trade primarily commodity options in there. It's a buy-only service. We're buying options. We buy puts and we buy calls. So we can play the up or downside in this market. And it's really an introductory service, but, we have a lot of expert traders that use it as well. It's just very easy to understand. So I tell people, if you've never traded commodities before, but you want to look at this side of the market and be able to play the downside, like right now, these commodities are all down, this is a good way to do it.
Very good. And I just want to give our listeners a quick update on our Indiegogo crowdfunding campaign. We're up to almost $1,300 out of the $2,000 we've raised. It's almost 65% funded. Excuse me, my voice is going. It's almost 65% funded with, I think, about 32 days left. So we're making good pace. And if our listeners want to donate, the link will be at the bottom in the video. Thanks again for your time, Kevin. I appreciate it. And we'll have you on again to talk about the commodities markets in the near future.
Great to be here, Jason. Thanks a lot.